Going to move on to the next topic, which is the economy.
Speak about the economy. Speak about the economy.
Bidenomics is about building an economy.
With Reaganomics, you cut taxes.
We'll build an economy where wage growth is stronger than it was in the past 3 decades.
I'm a strong believer in free enterprise.
America now has the best economy in the history of our country.
The President of the United States isn't meant to have much influence over the economy. Article 1, Section 8 of the US Constitution designates most of the economic power to Congress, not the President. But despite this, when we look at the US economy over the years that economic data has been available, we see an interesting and unmistakable fact. The US economy performs better when a Democrat is in the Oval Office instead of a Republican. This is hardly a secret or a recent discovery. Economic data is mostly publicly available and has been around for decades. What's more interesting is why this fact exists. That's what renowned economists Alan Blinder and Mark Watson tried to find in the 2015 paper. They confirmed that yes, a large and statistically significant difference in economic performance does exist and is correlated with the presidency, not any other factor. Sorry Republicans, and also sorry Democrats, but they found that it doesn't have anything to do with better economic policies. The real reasons for the difference aren't what you'd normally expect. But first of all, what do we mean when we say economic performance is better under a Democratic president than a Republican one? According to my independent and exclusive research, the most important metric to look at is real GDP growth.
I'll look at GDP first.
Real GDP, real gross domestic product, the total value of all goods and services in a country.
And luckily Blinder and Watson both agree with my findings. In their original 2015 paper, they calculated that the average annualized real GDP growth for a Democrat was 4.33%. And 2.54% for a Republican, a difference, or what they called a DR gap, of 1.79 percentage points. Adding on Obama's second term, Trump's first term, or only term, I don't know the future, and Biden's term so far, the updated DR gap is 1.41 percentage points. But for most of this video, we'll skip Biden, since his presidential term isn't complete yet. So the latest complete DR gap is 1.51 percentage points. A gap that's quite sizable, and more importantly, statistically significant, which is just the fancy way of saying that this difference is unlikely due to just chance. Okay, so a quick lesson on statistical significance. When you do statistical tests, you get something called a p-value, which is just a number between 0 and 1. Basically, to determine statistical significance, you want this number to be as low as possible, ideally less than 0.05 because that's the usual benchmark, but less than 0.1 or 0.15 can be acceptable depending on the context. The DR gap implies that over the course of a standard 4-year presidential term, the US economy grows more than 17% under a Democratic president and only 10.7% under a Republican president, a difference of nearly 7 percentage points. That's more than 62% more economic growth with a Democrat than a Republican. And Democrats have experienced this higher growth with less volatility as well. The standard deviation for Democratic presidents is 3.70%, but it's 5.18% for Republicans. But to be fair to Republicans, a large portion of this high standard deviation is due to the COVID shocks to GDP when Trump was president. If we take these two outliers out, the Republican standard deviation falls to a more comparable 3.82%, which is still higher than Democrats. So based on this statistical analysis, Democrats have presided over both faster and more stable growth. Looking at the column chart of average real GDP growth by presidential term, we can also make several inferences. We can see that GDP growth rises every time a Democrat gets elected. This is also true when we include Biden's term. And with the exception of Trump, GDP growth falls every time a Republican gets elected. When we rank the data from highest to lowest, Democrats make up 6 out of the top 9 presidential terms, and Republicans make up 7 out of the bottom 9. And it's with this chart we get the impression that Democrats are being carried by the Truman and Kennedy Johnson terms. And that impression is definitely correct. Putting the data back in order, the DR gap indeed does get smaller as we move forward in time. Just take a look at the DR gaps if we take subsamples after each Republican presidency. So it might be easy to look at this and think, oh, post-World War II America experienced a massive economic boom, especially compared to, say, the 2000s. So the DR gap must be due to Democrats incidentally presiding over periods of favorable economic trends. But I want to come back to this point later in the video. For now, let's look at another DR gap. Democratic presidents have experienced less recessions than Republican presidents, and it's not even close.
Now it's official, we are in a recession.
Our country could experience a long and painful recession.
The significant decline in economic growth that lasts months, even years.
From the start of Truman's second term to the end of Trump's, the US has lived through 128 Democratic quarters and 160 Republican quarters, totaling 288 quarters. According to the NBER, 51 of them have been recessions, 8 of them have come during a Democratic president, and 43 during a Republican president. This implies that, on average, the US is in a recession for 1 quarter during a Democratic administration and 4.3 quarters during a Republican one, a large and statistically significant DR gap of -3.3. But economic performance is more than just GDP growth and recessions. My independent and exclusive research says it also includes things like employment, inflation, income, and more. Surely the DR gap doesn't favor Democrats in these metrics as well. Before we get to the other economic indicators, let's look at 3 alternative measures of output besides GDP. When we control for population growth, the DR gap is 1.44 percentage points, similar to our original DR gap. We see much wider gaps when we look at non-farm output and industrial production. All 3 DR gaps are statistically significant to a high degree. Moving on to employment, payroll data shows that employment growth under a Democratic president has been more than double than that of a Republican president, and growth in employee hours worked is nearly 4 times higher. These 2 differences are again highly statistically significant. In household survey data, the DR gap is 0.59 percentage points, a decently sized gap and close to statistical significance. And these employment figures have unsurprisingly led to Democratic presidents having had lower unemployment rates than Republican presidents. The DR gap here is small and statistically insignificant, but when we look at the change in unemployment rates throughout a presidency, it's negative for Democrats and positive for Republicans, implying that unemployment rates tend to increase during Republican presidencies and decrease during Democratic presidencies. And when we look at the data, this is exactly what we see. In all but the 2 Reagan terms, the unemployment rates during Republican presidencies have increased. In all but Obama's first term, unemployment during Democratic presidencies has decreased. Democrats also have an edge when it comes to wages and productivity growth, although they're quite small and statistically insignificant. The DR gap is much larger when we look at total factor productivity, and it's almost significant at the 10% level. This political disparity between employment and income isn't surprising to political scientist Larry Bartels. In his 2008 book, he found that income inequality increases dramatically under Republican presidents, whereas it slightly decreases under Democratic presidents. Now moving from employees to employers, corporate profits as a share of GDI is higher under Democratic presidents, and it's statistically significant to the 10% level, which is ironic since big business tends to be associated with the Republicans, yet it prospers more under Democrats. And the stock market provides better returns under a Democratic president too. The S&P 500 returns 11.42% when a Democrat is in office, compared to 7.63% with a Republican. This Democratic domination over stock market returns was also explored by Santa Clara and Volkanov in 2003, and Orvine and O'Neill in 1980, which just shows how long this DR gap has existed for. And despite Democrats having a reputation for big spending, Democratic presidents also tend to have lower deficits as a percentage of GDP, although this DR gap is far from statistical significance. Under 3 popular measures of inflation, Democratic presidents have lower levels of inflation than Republicans. And since you're probably curious, if we add Biden's incomplete data, Democrats still retain a slight edge in all but CPI. However, it's not all bad news for Republicans. Under all 3 measures of inflation, inflation tends to rise under Democratic presidents, but fall under Republicans, with strong statistical significance as well. And that's to be expected. With higher GDP growth and higher employment, the Phillips curve tells us that inflation should rise under a Democratic president. And related to inflation, the federal funds rate is lower under Democrats, although it's not statistically significant, but it does tend to rise with Democrats and fall with Republicans, which is statistically significant. So, to summarize, in nearly all of the most important economic indicators, there exists a DR gap that indicates that the economy performs better under a Democratic president than a Republican president. Okay, let's shift back to the original DR gap, the difference in real GDP growth. we need to scrutinize this more. I mean, surely, GDP growth cannot actually be related to the president, right? Like, spurious correlations are a real thing. I mentioned at the start of the video that the US Constitution gives economic powers to Congress, so maybe it's actually Congress. Here's the bar chart of real GDP growth split by Congress. Now, if we color it based on which party controlled Congress, we see not much difference. A DR gap of only 0.4 percentage points. Small and unexpectedly also statistically insignificant. Alright, so maybe it's not Congress then. What if it was a different political feature of the president, not their party? Like, maybe if they had previous experience in Congress, or if they were previously a governor? Again, little difference. Let's look a bit further. Could the DR gap stem from something else? Like economic trends? Remember that a large portion of the DR gap is due to the early Truman and Kennedy Johnson terms. It's no secret that the US was an economic powerhouse after World War II, due in part to strong trends in labor force and productivity.
This was an era when Americans had fun.
So how much of the DR gap is explained by the timing of these trends? Blinder and Watson detrended the data using long two-sided weighted moving averages. The methodology is a bit complex, but it goes something like this. Here's a line chart of the GDP growth rate from Truman's second term to Obama's first term. If we completely detrended the data, we get a flat line at 3.29%, which, by no coincidence, is the average GDP growth of the US over the sample period. The completely detrended growth rates split by Democrats and Republicans are also flat lines at the sample averages, giving us a DR gap of 1.79 percentage points, the original DR gap of the paper. We'll use this as our benchmark. When we reduce the weights used to detrend the data, the detrended line naturally starts to vary. But importantly, the DR gap hardly changes. Even when the weight is reduced to a point where we start to capture cyclical elements, the DR gap still remains large and highly statistically significant. So we can conclude that the timing of these trends explains little, if any, of the DR gap. Another question we can ask is whether or not Democrats inherit an already favorable economy when they're elected. This would imply that Democratic presidents tend to be elected when the economy is starting to boom. Perhaps they're benefiting off of strong Republican policies. This might also imply that Republican presidents would tend to be elected when the economy is tanking, perhaps because of poor Democratic policies. If this is true, then our initial assumption of the direction of causality running from the elected party to economic performance is incorrect, and we should instead be looking at the economic performance causing the elected party. We can dispute this theory by breaking down the economic performance of each party within a 4-year presidential term, plus the year preceding the term. The graph shows that the strongest years of a Democratic president come from the first 2 years, at around 4.5% each. This is even more impressive since the economy they inherit only grows at 1.92%. For Republicans, they inherit an economy that grows at 4.04%, which then sharply falls to less than 1% during the first year of presidency. What we can infer from this graph is that Republicans are the ones with more favorable initial conditions, not Democrats. And despite this, economic growth tends to fall sharply when they're elected, but it accelerates when Democrats are elected. But we can dig into this some more. Were these turnarounds in economic performance expected? In other words, were Democrats elected when future growth was expected to be strong? Were Republicans elected when future growth was expected to be weak? Running a simple time series calculation would suggest the answer is no. We know that GDP growth is positively serially correlated, which means that high economic growth in one year is more likely to be followed by high economic growth in the next year. So when Republicans inherit a high growth economy, their first year of economic growth should be high as well. But from the graph before, we know it isn't. A more formal method to answer this question is to look at the forecasts of economic growth in an administration's first year and see if they predict large DR gaps. The Survey of Professional Forecasters and the Federal Reserve's Green Book forecasts have both, on average, forecast small DR gaps. Regressing 3 different time series models also provides very minimal DR gaps. Thus, we can reject the hypothesis that Democrats inherit more favorable economic conditions, and can also reject the direction of causality flowing from economic performance to elected party. Okay, so we've defined the DR gap and scrutinized whether or not it's real. Now it's finally time to ask, why does it exist? Assigning causality to a correlation is always a bit tricky. By adjusting the sample date slightly, Blinder and Watson found 3 main factors that contributed to the DR gap. The first factor is increases in productivity. Remember earlier in the video, I mentioned that productivity increases, specifically increases to total factor productivity, are much higher under Democratic presidents. Blinder and Watson found that differences in productivity explain 0.38 percentage points of the DR gap. The second factor is oil shocks. In 1983, economist James Hamilton argued that disruptions to the oil market were an important factor in causing recessions in the US. In 2003, he expanded on his work by proposing that oil price increases negatively affected economic activity, but oil price decreases don't affect the economy. Applying this method to the calculation, Blinder and Watson found that the Nixon-Ford term and the second George W. Bush term experienced the largest negative effects from oil shocks. Overall, oil shocks explain 0.36 percentage points of the DR gap. The final major factor is contributions to defense spending. Believe it or not, the United States has been part of many wars in the past 100 years. Shocking, I know. I don't know why we never hear about it more in the news. While the US's participation in wars is hardly partisan, when we look at the defense spending by party, real military spending grew much faster under Democrats than Republicans. And this DR gap can be primarily attributed to one president and one war. At the peak of the Korean War, President Truman increased military spending by nearly 150% at an annualized rate over one single quarter. If we removed Truman's second term from our sample, the military spending DR gap falls dramatically. So increases in defense spending, in particular under Truman during the Korean War, contributed to 0.13 percentage points of the DR gap. These three factors account for 56% of the DR gap, and the reasons that aren't directly linked to a president's economic policies, although there are political arguments to be made for each of these variables. Democrats experiencing better oil shocks could have been a result of better foreign policy. Faster defense spending could be linked to defense policy, and better productivity gains could be a result of various domestic policies. What about the remaining 44% of the DR gap? Someone familiar with economics would guess that the differences in fiscal and monetary policy might contribute to the DR gap. But Blinder and Watson found that they each contributed very little. So too did disruptions to the financial system and consumer expectations and uncertainty. So what variables make up the remainder of the DR gap? Blinder and Watson aren't too sure. From their paper, the rest of the DR gap remains, for now, a mystery. The word research, taken literally, means search again. We invite other researchers to do so. Maybe one day there will be a paper published that finds more explanations of the DR gap. And if there is, I'll try my best to make a video out of it. Thanks for watching the video and staying to the end. What's your opinion on the DR gap? Please like the video if you've liked it, and please subscribe as well. And also check out this video here if you want to see why personal finance YouTubers might not make any sense. Goodbye.